All right, so let's get right into it. Microsoft. I mean, this tech giant just dropped an earnings report that, on paper, should have been a home run. A grand slam, really. But what did the market do? It was a total bloodbath. So, what on earth is going on here? It's a crazy story, really. A huge paradox, a hidden crisis, and maybe, just maybe, a secret weapon that could change the whole game.
Just look at this. It's wild. On one hand, you've got a classic double beat. Revenue, up 17% year over year. I mean, they absolutely crushed the estimates. Earnings per share, a massive 5.3% beat. And Azure, their cloud business, which everyone watches like a hawk, it grew by 39%, right at the high end of what they promised. I mean, by every single metric, this report should have sent the stock soaring. But instead, the stock took its worst nosedive in 5 years. It makes no sense. Or does it?
And when I say nosedive, I'm not talking about a little blip on the radar. We're talking about over $350 billion in value. Just poof, gone in a single day. The scale of that loss is it's staggering. And it all boils down to one massive question.
Yeah, why? Why did Wall Street completely panic after a report that looked so good on the surface? I mean, is the AI hype train finally running out of steam? Or is there something else, a skeleton hiding in Microsoft's closet that we don't know about? Well, that's exactly what we're going to dig into and break down right now.
Okay, so it turns out, if you really dig into that earnings report and you listen closely to what was said on the earnings call, Wall Street sniffed out three, let's call them hidden landmines, that basically triggered this huge sell-off. Let's uncover them, one by one.
All right, landmine number one, Azure's growth. Now let's be clear, 39% growth is absolutely incredible for a business this massive. The problem? Well, last quarter that number was 40%. And for investors who've priced this stock for like infinite non-stop acceleration, even a tiny 1% slowdown feels like slamming on the brakes. It was the first little crack in the armor, and it was enough to make people nervous.
So, to get our heads around the second landmine, you've got to look at this number, $625 billion. That's Microsoft's remaining performance obligation, or RPO. You can just think of it as their backlog, all the work they have lined up and confirmed for the future. It's a gigantic number, right? It screams that demand for their services is through the roof. But this is where things get a little weird.
Right, so during the earnings call, Microsoft's CFO kind of dropped a bombshell. Nearly half of that enormous backlog, about 45% of it, comes from a single client. You guessed it, OpenAI. All of a sudden, this massive number looks a lot more fragile. Wall Street starts freaking out, asking, wait a minute, is this a brilliant partnership, or is Microsoft just dangerously over-leveraged to the fate of just one single company? It's a huge concentration risk.
And that brings us to our third and final landmine. And folks, this one's a biggie. $37.5 billion. That is what Microsoft spent on CAPEX, things like data centers, servers, chips, in just one quarter. That's up a mind-boggling 66% from last year. So now investors are looking at this picture. Azure growth is slowing down a bit, and at the same time, costs are just exploding. They're starting to feel that Microsoft is just pouring money into a bottomless pit with a return that's getting smaller and smaller.
So, okay, you've got slowing growth, this risky client concentration, and costs that are just soaring through the roof. That seems to explain the panic, right? Well, not quite. Because if you only look at those three landmines, you're actually missing the real story here. The real crisis, it's not what you think it is.
So let's just reframe this whole situation for a second. With a $625 billion backlog, demand is clearly not the problem. The orders are there. So, what if the real bottleneck for Microsoft isn't supply of customers, but supply of something way more basic? What if it's all about electrical power? What if they have all the orders in the world, but they literally can't find enough juice to run the servers to fulfill them?
See, that is the real challenge. You can't just snap your fingers and build new power plants. That takes years, and Microsoft needs a solution now. So how do you solve a massive power crisis when you can't just create more power out of thin air? Well, you get a whole lot smarter with the power you already have. And it turns out Microsoft has a secret weapon up its sleeve to do exactly that.
And here it is. Meet the Maia 200. This isn't some off-the-shelf chip. This is Microsoft's own, in-house, custom-designed AI chip. And it's not just another piece of silicon, it is the strategic answer to their single biggest problem.
So what's so special about this chip? Well, the Maia 200 isn't just about being powerful. Sure, it delivers 3 times the performance. But here's the real kicker. It's 30% more energy efficient than the last generation. In a world where electrical power is the ultimate ceiling, this chip lets Microsoft squeeze triple the AI capacity out of the exact same power grid. They don't need a new power plant, they just need a better, smarter chip.
And listen, this isn't some science fiction project for the distant future. This is happening right now. Microsoft quietly started deploying the first Maia 200 chips in its Iowa data centers back on January 26th. And they've already confirmed a global rollout for the second half of this year. This is the catalyst everyone is watching. This is what could finally unlock that massive backlog and lead to a huge revenue catch-up in late 2026.
Okay, so knowing all of this, how should we be thinking about this huge sell-off? It starts to look a little different, right? The short-term panic from Wall Street might actually be a golden long-term opportunity for anyone who understands what's really going on under the hood. So let's break down the investor playbook here.
The bull case here is pretty clear. Demand is absolutely off the charts. That Maia 200 chip is the key that's going to unlock all that growth, and this big sell-off has basically put the stock on sale. Now, the bear case is that the first half of this year is still going to be a bit painful. All that spending means high depreciation costs, which is going to hurt margins in the short term. So the real question really just comes down to one thing: patience.
One thing is for sure, though, this crash absolutely triggered a valuation reset. Microsoft's price-to-earnings ratio, which is just a way of measuring how expensive a stock is, had gotten a little bit ahead of itself. This sell-off brought it right back down to around 30. And for a company with Microsoft's growth potential, that's historically a much more reasonable, almost a sweet spot price. It suggests a lot of that speculative froth has been washed away.
So if you believe in this long-term story, here are 3 key price levels to keep an eye on. 485. That's the first major level of technical support, kind of the dip. If the market panic really takes hold and pushes it down to 395, well, that could be a steal. And then there's 343. That's the critical line in the sand. If it breaks below that, it could mean the whole AI story is in trouble.
And hey, if you want to play this trend, but maybe not by buying Microsoft directly, you can always go for the picks and shovels play. Think about Constellation Energy. They are literally restarting a nuclear power plant just to power Microsoft's future data centers. And then there's a company called Vertiv. They make the super important liquid cooling systems you need to keep these new, powerful, and very hot Maia 200 chips from melting. As long as Microsoft keeps building, companies like these win.
So when you boil it all down, it comes to this. The market's short-term freakout has created a potential discount on a world-class company that has a clear, actionable solution to its biggest problem. The story here isn't about Microsoft failing. It's about short-term traders losing their nerve. The real question for you is, do you have the patience to wait for the Maia 200 to finally pay off?